Good afternoon, and thank you for joining us for this panel. My name is Allison Koester. I'm an accounting professor here at McDonough, as well as a faculty associate at the Psaros Center. I'm delighted to introduce our next panel for a discussion on digital assets. This is a topic that is timely, relevant, and very interesting, as our last panel alluded to multiple times, which I was excited to see. Digital assets should be of interest to everyone, from policymakers crafting laws and regulations that we just heard about, to corporations and individuals holding, valuing, and trading these assets. I was excited by the show of hands as to how many people are actually involved in this personally. From my firsthand experience in the classroom, our McDonough graduate students are very interested in career opportunities in this space as well. Our expert panel to help us learn more about digital assets includes Susan Friedman, a Georgetown Law Center alum who currently serves as the head of public policy at the blockchain tech firm Ripple. Prior to joining Ripple, Susan was at Treasury, where she worked on issues related to international financial services regulation and investment security. Anna Paglia is the global head of ETFs and index strategies at Invesco, and has more than 2 decades of experience providing thought leadership within the ETF industry, both in the US and in Europe, through her role at Invesco, as well as through her prior work at K&L Gates and Barclays. Neal Kumar is a partner in the corporate and financial services group of Willkie, Farr, and Gallagher, where he works with major financial institutions and other digital asset ecosystem participants. In addition to helping clients successfully navigate CFTC rules and regulations, he also advises clients on the use of blockchain, digital assets, and cryptocurrencies. Our expert panel is moderated by Makepeace. Mark is the CEO of the global investment technology and advisory firm Wilshire, and a valued member of the board of advisors at the Psaros Center. Mark, the floor is yours.
Thank you very much. Digital assets is one of those subjects which I think we all associate with disruption. We're all sort of thinking about this as a subject where we're not certain of the risks. We believe there's huge opportunity going forward, but we sort of know, both in terms of the underlying technology and the new ways of trading, tokenization, coins, that there are huge implications for the industry going forward. I'm going to start and open up this discussion with a broad question, but I will, as we go through our discussion, I'll leave time towards the end, 15, 20 minutes for questions from the floor, but I'm sure it's going to be a lively debate. So let's get started. My first question is just that. I mean, digital assets, how do we define what we mean about digital assets, and how big a disruption is it going to be for the industry? Perhaps, Anna, you want to start?
Sure, absolutely. I'm happy to. And thank you for having me. It's such a pleasure and a big honor to be here today. I think that you are asking absolutely the right first question, which is how do you define it? Because every time that you hear the words digital assets, you associate that with Bitcoin, cryptocurrencies. And it goes without saying that cryptocurrencies play a big part and a big role in the digital assets ecosystem. But digital assets are much more than that. It's an entire ecosystem, a combination of players, blockchain technologies, and think about softwares and hardwares and all the players that you really need to compile this big ecosystem. So we have a high conviction in digital assets and the role that the digital assets are going to play in the new and future and modern economy. We hear all the time TradFi, DeFi, and DeFi is real. We have to pay attention to that. And especially for the students in the audience, if you don't remember anything that I'm going to say today, which happens all the time, I would like you to remember just one word, and that word is convergence. Why is it important for digital assets? When I grew up, we watched the movies in one room. We answered the phone in another room. We listened to the radio in another room. You hear all the time a reference to the iPhone moment. The first time you had everything at your fingertips. You had the internet, you could listen to the music, you could call your friends, watch movies. Smartphones transformed our way of life because of that one word, convergence. All these different means converged into one single piece of equipment. And the real disruption is that type of disruption that you don't even think about. It changes your life. You start doing things differently and it comes automatically. You don't even have to think about what changes you have. You just do it because they make your life so much easier. And when I think about DeFi and digital assets, the smartphone comes to mind because today we have fragmentation in our finances. And fragmentation is the opposite of convergence. Think about an environment in which all of your holdings, all of your assets converge into one. You have one single wallet that you can use to buy items, to trade, to buy securities, to exchange commodities. DeFi is that convergence. And we do believe it is in the making, it's around the corner. The environment, the ecosystem is moving fast and furious. And this is why we have so much high conviction in that. Convergence is going to be powerful because it's going to bring all of that together. The future of smartphones in finance lies on digital assets.
Okay. Thank you. Thank you for that. Convergence versus fragmentation of today. Susan, I mean, what's your view of digital assets?
Thank you first for having us here. It's great to be here today to speak to everyone. I totally agree with Anna's points and the ones that she raised. I think, digital assets covers a really broad category. And if you look at President Biden's EO, it's CBDCs, it's crypto, it's stable coins. In terms of convergence and the disruption that we'll see, Ripple works primarily in the cross-border payment space. And I think our products combined with crypto have already transformed how companies can move money cross-border, changing a process that lasts 3 to 5 days currently with opacity and delays to something that can happen within seconds. But I think what struck me most in listening to Anna is that I don't even think we've really seen or have a grasp of the full range of applications or things out there that can cause disruption because we don't have the regulatory clarity within the United States to cause companies to come here to develop, to innovate, and to grow. And until we solve that problem and resolve the fragmentation with respect to our regulatory state, it's going to be hard to really grasp or realize the full potential of digital assets within the US today.
Thanks, Susan. Neal.
Yeah, hard to follow both of those opening statements, so I'm going to do my best. I think you set the stage perfectly for how disruptive it could be. And I would just say for the students in the audience, for really everybody here, a lot of times in the mainstream media and a lot of other places, like just general discussions, you feel like the success of digital assets is the price of Bitcoin or the price of ETH. And I think we just need to divorce ourselves from that subject, right? Because the underlying blockchain technology, the use of DeFi is just incredibly disruptive to a number of industries that I couldn't even have imagined, 6 months ago, a year ago. It just seems to keep evolving. And we've calls with clients, I want to try and do this project in this industry. And it's like, oh my gosh, I can't believe you could do it. Like, wow, that's amazing to me. And so I think we need to stop saying, okay, look at the price. Like, everyone wants to know what the price is doing. Okay, I get it. But the success of digital assets and what they can do is not the price. The success is the industries that they can impact over the course of time. And that's continuously coming. And again, we're seeing it in industries that I never would have even thought are relevant here, and it's continuous.
Yeah, and it's a very good point. I mean, cryptocurrencies and the focus on sort of Bitcoin and a small number of these coins is really distracting us from the potential benefits that this technology and the DeFi approach brings to the industry. Very good point. Let's talk about the regulation side, because clearly the scale of change here represents a huge challenge to regulators and regulators around the world. So maybe we can first get some views on some of the sort of issues you see that the regulators are trying to tackle. And then perhaps we can talk about where we think sort of best practices starting to emerge. But maybe Susan, we should start with you.
Sure. So I think, the fundamental issue, just looking at the US to start with before we go to other jurisdictions, is that distinction. There are a number of regulatory challenges. Stablecoins is one that's attracted a lot of attention. One that we are focused on and a lot of industry is focused on as well is that distinction between what's a security and what's a commodity, which the panel before us touched upon. There are a number of legislative proposals currently pending in Congress, all of which are encouraging in the sense that they're bipartisan. They purport to give the CFTC jurisdiction over spot digital asset markets. But it's that line between how do you define what's a security, what's a commodity, do the bills get it right, will they get traction to move forward? Until we break through that legislative gridlock, it's going to be hard we're going to continue to have this regulatory ambiguity in the US. And we're seeing it play out because the SEC has come forward and filed enforcement actions, the Wahi action, most recently against some former Coinbase employees, where they singled out 9 tokens, called them digital asset securities. But what is a digital asset security? If industry had a clear understanding of where those lines were, it would be a revolution in the market as opposed to what currently exists today.
Thank you. Anna, it must be difficult for you in this area with the lack of sort of regulatory sort of structure here.
Indeed, it's difficult for us. So at Invesco, I head out the exchange traded fund business, and for us, ETFs are a technology. And this technology is so compelling because over the years, it has given us an opportunity to offer to investors something, a basket of securities or an asset class that would be difficult for them, especially for small investors, to buy directly. So think about 30 years ago with the first ETFs, with $25, one small investor could access a basket of securities, the S&P 500 or the NASDAQ 100. The technology has evolved and the offering has evolved. The opportunities have evolved. With the ETFs, clients today can access emerging markets. They can access fixed income. And we think this is a very effective tool to access digital assets and cryptocurrencies. In addition to being easy to trade, it gives investors the protections of the 40 Act, things that they don't have when they buy the currency themselves. We were talking about it at lunch today, and I mentioned the fact that in December, I went home for Christmas, and my dad said, 75 years old, he said, "You should be so proud of me. I bought Bitcoins." And he showed me an app on his phone, and I said, "Dad, did you redeem your Bitcoins yet?" And he said, "No, not yet. It's not the right time." And I said, "Okay, funny you say that, because as far as you know, you gave money to somebody. They gave you a fancy app on a phone. I don't know if you bought Bitcoins." There is no protection around that. There is no regulation around that. And my dad is not as sophisticated as other investors to go to the big currency exchanges. So having something with the protection of the 40 Act in a wrapper that is regulated would really help investors access that underlying asset class without being at the mercy of anybody who just gives you an app. I still don't know if he has Bitcoins, for the record. But right now it's difficult because this is public information. We have a filing out there with the SEC. We have been trying to launch a Bitcoin ETF for many months. And because of lack of clarity in regulation, that filing has not been cleared yet. In the meanwhile, we have launched the products that give access to the rest of the ecosystem, to the big public companies that derive their revenues from blockchain technologies or digital assets in general, but we still don't have clarity on how cryptocurrencies are going to be regulated. We cannot even call them currencies. Okay, I get it. And we still don't know if it's a commodity or a security. And as far as I'm concerned, Mark, it doesn't really matter. As long as there is a regulation, there is a clarity in the regulation, which gives us a roadmap, because our goal is not to push the envelope, is not to break the envelope. Our goal is to navigate the regulatory environment. And if there is no clarity there, it's going to be really, really difficult to do that. This is going to impair innovation, and it's also going to give rise to regulatory arbitrage, because financial markets are borderless. If you cannot buy a Bitcoin ETF here in the US, you are going to buy it in Canada, you are going to buy it in Europe, you are going to buy it in Bermuda. So clear regulation is going to be much needed. And I would say the speed at which that regulatory framework comes to life is also very important, because this industry is changing, is going to change. 5 years from now, our panel is going to be completely different. And we cannot wait months and years for regulation to be developed and not catch up with innovation.
So your point is people are buying crypto assets.
Correct.
And they are exposed to all the risks of buying those crypto assets in an unregulated market.
Correct. Different regulation or unregulated.
And if regulators, if we had a regulatory structure,
correct,
some of the existing providers who are much more secure would be able to provide these crypto assets within a more secure environment for those investors. Because I understand that. Neal, I mean, the challenges of the regulators. I mean, do you have sympathy for them? I mean, it's difficult, isn't it?
Sure. I mean, having been one myself, in a former life, of course you do. I mean, so the CFTC, you talk about the distinction, Susan mentioned, distinction between a commodity and a security. The CFTC, their definition of commodity was written in 1974, and they have to apply that definition to digital assets. I mean, that's really hard, right? And if you go read the definition, it's a bunch of agricultural commodities. And I think on the last panel, I talked about how it excludes onions and it excludes movie box office receipts. Fair. And then it says, and any type of interest that can be used to make a futures contract now or any point in the future, which is what kicks the definition wide open, right? And so can you use an underlier to make a futures project? I can use an underlier to make almost any type of futures product, right? And so it's very hard for me to say a digital asset is not a commodity. And then on the security side, we're using a Supreme Court decision from the 30s that has to do with oranges to figure out if it's a digital asset as a security. Again, a flawed framework, but that's all they have to use right now. And so navigating that distinction, I know the SEC put up a 37-factor test that you're supposed to somehow throw in the air and juggle and figure out what is a security, but it's just, we need legislation, we need Congress to step in and really sort of help divide the lines. Because the other piece of this is the CFTC's jurisdiction only goes so far, right? So once you call it a commodity, even if it's not a security, that doesn't mean the CFTC can regulate it. It just means the CFTC has anti-fraud and anti-manipulation authority, so they can sue you for fraud or sue you for manipulating the price. They can't regulate you as an institution. They can't require that you register. They can't impose customer protection regimes. It just sort of sits there, and the CFTC kind of oversees to make sure that, like, fights don't break out in the house, but they can't regulate.
Will there be a difference? I mean, if the CFTC regulate digital assets, or if the SEC regulates digital assets. I mean, I always associate CFTC with derivatives, more innovation, and bringing innovation into financial markets. And they've done that very successfully. I associate the SEC with protecting investors in the equity markets. And again, they've done that job very well. So, I mean, in your view, does it make a difference which regulator, has the lead in bringing in regulation here?
So I am hardly an unbiased witness. I'm going to say that up front. So I'm going to push back a little bit on the idea that the CFTC does customer protection. They do it very well. And they have been at the forefront of innovation in the past. You had the Commodity Futures Modernization Act in 2000, which really put the exchanges in the driver's seat of innovation. And there's a reason we lead the world in futures products. And that's the regulation of the CFTC through direction from Congress. And so, you know, again, I'm hardly an unbiased witness, so I'm going to be a cheerleader for the CFTC. And I think what you see in the legislation is both the Lummis and Gillibrand bill, who I believe they'll be on later in the panel later today, and the Stabenow-Boozman bill, both cede it's at least some jurisdiction to the CFTC. Now, what's interesting, and I'm going to try and not nerd out too much on the audience, but when you do a comparative analysis of those two bills, when you look at the jurisdiction that they give the CFTC, it's actually very, very different. So the Lummis-Gillibrand bill focuses on the exchanges. And so they say, if you want to, and the trigger to register as an exchange is if you have retail participants that want to trade on margin. Otherwise, you don't have to register. You can opt not to register or register. And then once they register, then the CFTC gets jurisdiction. On the flip side, you have the Boozman-Gillibrand bill, or the Boozman-Stabenow bill, which looks a lot more like what Dodd-Frank did to the Commodity Exchange Act back in 2012 or 2010, which was they take the CFTC's jurisdiction and they plop it on top of digital assets. And so you have OTC, what I would call OTC, the OTC space gets regulated, the exchanges get regulated, they have dealers that are being regulated. It's a full regulatory regime. So they're very different. But at least thus far, the major legislative actions that we've seen is Congress taking the view that it should be the CFTC, at the very least having a seat at the table, and certainly, you know, driving a lot of the discussion around regulation of digital assets.
Yeah, and I do believe that the US in the end, this is an area they will want to lead in. So I do think it's very important. But let's talk about practices around the world and best sort of practice that we see today. I mean, Susan, I mean, Singapore have tried very hard in this area. The Swiss markets, they're bringing in regulation. I mean, is there a best practice somewhere that perhaps the US could follow, or do you think they've really got to create a new environment?
I think before I answer that, I do also just want to touch on one point. The current markets are not unregulated. Crypto platforms do have to register as money service businesses. I think everyone's in agreement that a federal regime with those oversights is important, but it is a mistake to think that consumers are wholly without protections today. In terms of what is best practice, I mean, I think Swiss have a framework. Singapore has its Payment Services Act. The EU just passed a landmark markets and crypto asset regulation. This isn't to say that the proposals on the table in the US aren't good ones. And I think what's significant to your prior question is that the SEC is not cut out of any of them. What those bills do is look to provide clarity between those two agencies in a way that is necessary, given that no rulemaking has occurred on this by either with respect to digital assets. But the key point into your question about who to follow, it almost doesn't matter, because the fact that these jurisdictions have come out with holistic frameworks that govern the markets, set the benchmark, and unless we break through and actually pass something, there is no reason, and our CEO has said this before when he's asked, should businesses establish in the US, his advice is go to a jurisdiction where there are clear frameworks. Why would you come to the US and risk a regulatory enforcement action by the SEC at any point when you can go and establish in Switzerland, in the EU, in Singapore? I think what those jurisdictions have right, it's categorization of the assets, it's comprehensive regulation of the platforms and the service providers, it's clear consumer protections. All of those are things that I think the Stabenow-Boozman bill try and do, the Lummis-Gillibrand bill does, the Digital Commodity Exchange Act on the House does. But the difference is that those pieces have been passed while the US is still debating, trying to figure out which path forward. Is there going to be time before the end of the year? If not, all of these bills have to be reintroduced again, and that it just takes time in an industry that is shifting, you know, by the month.
So
Mark, I agree with that. You know, going back to what we said about clarity. Because there is one thing that markets don't like, and that is uncertainty. And uncertainty is what kills innovation, and this is what players like ourselves don't like, because if there is a big gray area that you are unable to navigate, what do? You go on defense. So you try to build legal compliance. You try to act thinking about a future state where you are going to be sued, where you are going to receive that letter because there is going to be an enforcement action for something that you did in the lack of clear rules. So removing that uncertainty is important. And as far as CFTC or SEC, I am completely unbiased. And I can tell you that ultimately, I don't care. As long as there is clear empowerment, Congress should empower, regulatory agencies should execute. But there should be a very clear framework within which we can operate.
Because to that point, I mean, are we at risk of a sort of regulatory arbitrage? I mean, do you see that as a particular issue?
I mean, certainly, and I just wanted to tack on to what both Anna and Susan had said, is we are at a point where I think there's a lot of talk about needing to get things perfect. And I think that just can't be the goal, because you're not going to do it. And the problem with, waiting until you get it perfect is that Europe's going to finish implementing their regime and most of the world is going to finish. And what we saw during the last major financial rewrite of the regulatory system was those that finish first get to drive the bus a little more than those that don't. And so a lot of the rules that were set up in the US, so the CFTC under then Chairman Gary Gensler pushed ahead and finalized an OTC derivative swap reform very quickly. And Europe was catching up, right? And so in this, at this point, there is a need to get it right, but there's urgency, right? Because we have plenty of clients where it's like, I'm not going to take the risk. I'll sit on the sidelines. I'll go offshore. I'll go somewhere else. And that's not good for the United States.
This reminded me of one very famous US general said decades ago, if you don't like change, you are going to like irrelevance even less. Perfection means we are going to have to wait until we get it right. Guess what? That day, the environment will have shifted under your feet. So there will be no perfection, and you are going to have to wait again, because change is going to become the new normal in this environment, especially when it comes to digital assets. So building that type of clarity but flexibility and not getting it right is never going to be right, because this is going to change by the day, it's going to change by the month.
Okay, perhaps we talked about some of the regulatory challenges. Perhaps I can move us on to some of the issues around disruption that the technology is likely to bring. And some of the obvious areas such as custody that this new approach brings. But it's going to be a difficult transition from where the market is today to that new approach. To go from a T+2 to T0 in many markets is a very challenging change. So what are people's views on what they see as the early stages and early steps we're likely to see in the market? Anna, so what are you going to do in the product side? I mean, if you're thinking about ETFs, now they're available in Canada. Are you thinking of different types of products for the US if you don't have the regulation here?
We have different products launched in different markets. The obvious one is we have a Bitcoin ETF in Europe. We don't have a Bitcoin ETF here in the US. Regulation is only part of the driver in making that decision, but the strengths and the adoption of new technology by the different players in the ecosystem also played a big role. Because, for example, in Europe, we partnered with a custodian bank that is a licensed custodian bank. Custodian bank is a crypto custodian. And that market has adopted this new technology much faster than our partners here in the US. In the last couple of days, we have heard that one of the big custodians here in the US has started and has launched a crypto arm of the bank, which is also going to play a role as to how to assess the robustness of crypto ETFs to come in the future, I hope, in the very short future, I hope. But you are absolutely right. I mean, this entire ecosystem and the ability of every player to adapt to these new technologies is going to drive success or not. And ultimately, what we want is this new industry, this new part of the industry to come across fast and right. Because, you know, this is where I'm speaking from two sides of my mouth, because speed is incredibly important. But this is one area where you have to get it fast and you have to get it right. You cannot undermine one for the other.
Okay, Susan.
I think just on the topic of disruption, you know, again, we are focused, and I think a number of companies are focused on that cross-border space and how do you make that process better, easier, faster, better for the consumer, especially because a lot of times when you're transmitting money cross-border, it's to people who really need every cent counts. And so when you have funds that are chewed up in fees or that get lost, it makes a difference. And up to, I think the World Bank estimated 6 or 7% of money that's sent cross-border can get eaten up that way. And so the disruptive technologies and the digital assets that allow money to move faster and quicker in that manner is something that we're paying really close attention to, in addition to tokenization of other assets. But I think there is a lot of interesting applications that are coming down the pike.
Yeah. And Neal, your view on tokenization, how disruptive do you think that will be?
It's already been disruptive. And I think what you're seeing in my space, you're seeing a lot of in the underlying commodities and tokenization of underlying commodities. I think that's going to revolutionize the way we trade physical commodities. I think you're seeing it plenty in the carbon markets, which, you know, are underlying, you know, they're based on digital warehouses anyway, which I think makes the transition a little bit easier. But I think you're going to see, you know, physical commodities is probably the area that's most soon to take off in the tokenization space. And it's just going to revolutionize the way we trade. It's going to simplify it, which is, you know, right now it's more complicated than a lot of us appreciate. And I think it's going to really make it much more efficient.
Yeah. And tokenization in your world, in your experience, are you seeing good examples of early sort of forms of tokenization?
So ETFs are tokenized already. If you just Google it, and if you look at the different exchanges and players, so you will see that flagship products like the QQQ, they already exist as a token. And tokenization is really the next level of simplification. We look at many different assets that can be tokenized. Right now, the focus is really on real assets. So think about the ability to tokenize a building. You will be able to buy tokens representative of your ownership in the Empire State Building. And the value of that token is going to be up and down based on how many units are rented. So again, tokenization is going to be powerful because it's going to democratize access. And to me in particular, the type of democratization is what is going to move markets, because it's going to give the ability to every investor, big or small, to access a particular asset at any stage of their investments, their investment cycle.
Yeah. And in this new environment, if we think of a world which becomes more tokenized, we have today the sort of traditional exchanges we're all familiar with their sort of infrastructures, which are based on a centralized model. And then you have the emerging crypto exchanges. And you're already starting to see some clashes between FTX and CME. So in this new world, do people see these exchanges coming together, or do we see a battle to see which survives, and or is it one overtakes the other?
Yeah, I'm happy to jump in. I don't see it quite as a battle for survival. So for those, the FTX proposal would allow market participants, in particular retail, to come in, trade futures, and have a direct clearing relationship with the clearing organization rather than going through an intermediary called the Futures Commission Merchant. So, and that's this historical model has been, you go through your FCM to clear your contracts. And there are asset classes where I think FCMs provide a tremendous amount of value. And there are those where, and there are some market participants who may not think so. And so I don't see it as one survives and one dies. I just see it as you're going to see a disparate approach, and we're going to see what the CFTC does with the FTX proposal. But if it were allowed to go forward, I can envision a world where you see, crypto assets going direct to clearing. CFTC's done direct clearing in other contracts, but in the ag markets, I don't think you're going to see too many farmers that want to go direct to clearing. Their relationship with an FCM is critical to their survival and their ability to hedge. And so I don't know that we're going to get a world where you have one model. I think you're going to see a sort of disparate.
But can I challenge you a little bit there, Neal? I mean,
No.
is that a first move? Is that a first move? Is it FTX does this first on digital assets, and then FTX tries to challenge in terms of equities and other contracts?
I think we're going to have to see how the regulators react, right? So they can only do what they're authorized to do by the CFTC, and so we're going to have to see if they get approved to do this, what asset classes they can do it for, and if they can't do it for. If it's limited to crypto, then they're not going to be able to do it outside. So for metals and ags and all the other contracts, where I think we would expect, or a lot of customers expect and have very loudly voiced their preference for an FCM.
Okay.
And first mover, I'm sorry. Susan.
No, go ahead.
And I agree with that, because first mover advantage, it's real. It's going to create an opportunity for whoever is going to be able to move first, but it's not going to translate in the winner takes it all. So I think that this is going to translate in optionality, and at times the disintermediated route will make sense. At times it will not make sense, but what is going to provide is competition, which is going to lead to a race to the top instead of just winner takes it all.
Yeah, I like the race to the top. Yeah, Susan.
I agree with what both Anna and Neal said, and not to bring it back to policy, but since that's the hat I wear, Senator Hickenlooper yesterday sent a letter to the SEC echoing some points that Coinbase has raised before, which is that for these exchanges which are operating in new ways, you need new rules. There need to be rules that deal with decentralized exchanges and how you are going to deal with the lack of an intermediary in the way that you have in these traditional structures, because they don't fit neatly into the box. And if you want them to function the way that they're supposed to, then there has to be some real engagement with industry and engagement in the rulemaking process.
But is the industry going to have to sort of adapt to these new ways? Is there really a world where you have a centralized and a decentralized model, or do these things come together? Maybe there's certain assets which trade in a more centralized way, but increasingly a market that becomes 24/7 in a decentralized, lower cost, more efficient, frictionless trading.
Probably.
Certainly, I think there's movement's going to have to come from both sides, right? You have envision a world where the CFTC is the primary regulator. They've operated since the beginning of their existence in 1922 based on a centralized clearing model, where you have a central counterparty that sits in the middle of everything, and their job is to protect risk for everybody. And that's the opposite of what DeFi is, right? And so just saying, okay, now you have to clear, that's not an answer. But just saying we're going to do the business we've been doing it when we were unregulated isn't going to. So, we're going to see it play out in legislation, and there's going to be, let's say we get legislation next year. I don't know that, but like, let's say we get it next year. We're a long way off from having an actual regulatory environment, right?
Yeah.
We're probably dealing with like a year or two of rulemaking. And there's going to be a lot of work to do on that front.
Okay.
But if the suggestion is that decentralized parties somehow become centralized because that's the force of the regulatory push, I don't think that's right. It does not seem to be where anyone is headed. I think there's real acknowledgement and respect from regulators and legislators that there are these models out there, and there's a need to protect consumers, but not to force the industry into one centralized box.
Yeah, and then we've seen how quickly CME have reacted. So, I mean, market forces are very powerful. Yeah. We're going to open up to some questions. But whilst we find our first sort of question, one last question I'll ask the three of you is, at the moment, certainly institutional investors are, any holdings of crypto assets are quite small in terms of their portfolio. Us as an advisor, we've been sort of asking ourselves the question. We don't have the answer, but we've been asking ourselves the question is, should investors start to think about holding a small percentage of their portfolio in crypto assets? I'd love to hear each of your views whilst we're waiting for some questions. Perhaps I'll start with Anna.
So, thank you.
It's a tough one. I saved the hardest one for the last.
Yeah.
Yeah, I like that. Thank you so much. So I'll tell you something that I heard from somebody, which is if you want to invest in crypto assets in the current market environment, make sure that you invest only that portion of the portfolio that you are willing to lose completely.
Yeah.
Because I don't know that the situation is as bad as this sentence conveys, but it's a very volatile investment.
Yeah.
So I don't know that I would ever suggest anybody to make that investment as part of their core portfolio. But definitely, if you are an investor who is not risk adverse and you can afford to take a risk in a volatile asset class, why not?
So only for the brave. Okay.
Yes.
Susan.
I'm going to punt a little bit on grounds that Ripple utilizes a crypto asset for its product, but we are not retail facing. We only deal with financial institutions and are not involved in this specific area at all. So I will defer to the experts on that.
I'm just going to say that I'm a lawyer, and if you come to me for investment advice, I feel really sorry for you.
Okay.
You're going to get what you pay for if you come to me.
So there's no investors here. First question, please.
My question is for Neal Kumar. I wanted to follow up on your remarks about futures markets. My interest in the issue is regarding prediction markets specifically, but I think there's a broader question here. Why do you think Congress has not generally provided regulatory clarity here? And do you think that they, in fact, just want to defer to the CFTC and others? Or do you think something needs to happen politically for Congress to provide not just an ad hoc approach like with onions and movie futures, but really just provide some broader framework that regulators can act upon?
Is this specific for prediction markets or just generally, or both?
Well, maybe I would be interested if you think prediction markets are a unique issue, or you think this is a challenge just presented in the futures.
Yeah, so I do think prediction markets present a unique issue. So a month or so ago, one of the CFTC's regulated exchanges filed a contract that was a binary option that was based on the outcome of the upcoming election. So would the Democrats control the Senate? Would the Republicans control the Senate, and vice versa? Same is true for the House. The CFTC has already reviewed those style of contracts in the past, and they historically rejected them. And the analysis went, so under the Commodity Exchange Act, if contracts have a certain underlying event, then the CFTC can deem that they're not in the public interest. And the public interest test is, does it provide a hedging utility, and or can you use it to price a transaction? And so when the CFTC looked at this in 2012, this exchange Nadex had filed very similar contracts. They said the risks that you would need to hedge based on the outcome of election are too sort of tangential. There isn't a direct risk that you could hedge with use of a prediction contract. And so we're going to say it's not in the public interest because market participants aren't using them to hedge. So Kalshi's filed the same thing. I think there's a lot more analysis of whether or not elections can create real risks. And so the CFTC is looking at that now. It's an area where, at least thus far, it's within the CFTC's jurisdiction. I don't know that they need more sort of guidance from Congress. Perhaps what is and is not in the public interest, you could see Congress, like that's something Congress typically does. But it's an analysis the CFTC has done before. And I think, we're going to see at least in the next couple of weeks, how they're going to weigh in on prediction markets. And so I don't see that as I think the remaining issue of what is a commodity. I think Congress in 1974 intentionally defined it as broadly as they could, really to allow the CFTC to run with the futures markets. And so it certainly is time for a rewrite. Oddly enough, the way they deal with it, and this is because this is a very challenging topic, is they just add digital assets into the definition. So now you've got a list of agricultural commodities plus digital assets in between the exemption or the exclusion of onions and movie futures. And so it's challenging. And so if you're going to write what is a commodity, it's because it's not, it's not something you eat, it's not something you touch, it's a lot of things. And so they tend to do it in a reactionary way. And I think that's why we're seeing it develop the way it did.
Please, next question.
I'm gonna defer to you. That's not wise. So I guess this may reveal my complete ignorance of digital assets, but I guess my question is largely for Susan. What is it about the existing payment system, or the lack of it, or the lack of coordination across borders that presently causes it to take 4 to 5 days for cross-border payments to occur, and that allows you then to somehow, I really don't understand the mechanism through which you're avoiding whatever the process is that does that. And you had also mentioned something about the fraction that goes toward fees and that, otherwise could be avoided. Is it something in the existing financial payments infrastructure that just there's a big friction there somehow?
That's a great question. So SWIFT is the payment system that's used, and the comparison that I use to describe it, it's like snail mail. You have to receive the message that I send to see who the sender is, what they're sending, before you can send a message back regarding the payment, the interbank payment at issue. Ripple uses a blockchain-based software solution that the easiest comparison is like WhatsApp. So you and I can exchange information in real time about who sender, receiver is, what they're sending, all of that. And when banks incorporate our software into their system, it provides, and they are still regulated, connected to all the existing oversight that exists in their relative respective jurisdictions is in play. But software provides a better solution in terms of communicating the information that's needed to communicate money going cross-border.
Should SWIFT be using blockchain?
I think SWIFT is looking at those options right now and evaluating ways to improve their system. But Ripple is not the only one operating in this space. There are a number of different companies that I think have recognized the friction in cross-border payments. There are better ways to do this than what exists today.
Right. I guess just the more I listen to panels on stablecoins and all these things, it kind of makes you wonder, what is it about the system that's lacking that is causing this innovation to occur? And perhaps there should be some of that innovation, I don't know, applied toward the existing infrastructure, and that would also help with fragmentation to reduce it. But yeah, thank you very much.
Yeah, I think it's also worth adding that I was at dinner last night and someone was telling me he was trying to move money from his US bank to Hong Kong And it took him something like 4 or 5 days, and he had heavy fees to pay. Whereas if he'd used the sort of technology like Ripple that's available, he could have done it immediately with very little cost. Now, some of that may not be just the technology. It may be just the sort of all of the sort of infrastructure that exists around today, which is largely protection. But if you do something immediate, much of that protection isn't needed. Okay, it falls away. Please.
Sure. My question is, I think, mostly for Anna, but obviously we talk about one of the main arguments you hear is that crypto or digital is not suitable for retail because of the volatility. And so following that all the way through, when we get to a point where we have a sufficiently robust regulatory framework such that the Invescos of the world can, launch products in the space and be fully operational, what, in a very sort of tangible investment sense, what do you anticipate is going to be the impact on the volatility of the market by having those types of players participate?
So thank you for the question, because first of all, it's my fault if I imply it is not suitable for retail investors. It's not.
No, one of the arguments that you frequently hear, not that you had made specifically, but something that's frequently talked about, is it's too volatile for retail.
You are touching on something that is really important, which is it's not a matter of suitability, it's a matter of transparency. It's a matter of managing expectations based on your investment risk, your risk tolerance. So right now, it's retail investors can access digital assets if they have that particular risk tolerance. What a future state of regulation allowing sponsors like ourselves to bring regulated products to market will do is offer 40 Act protection or 33 Act protection that today is not existent. So it's not about the underlying is not going to change. The volatility in the underlying is not going to be changed by the addition of an ETF or 10 ETFs to market. But what you are going to give is a wrapper that the retail investors can use to get access to that underlying technology with the protection of the 40 Act. If you want to exit that investment, you can do that and get your redemption settled on T+2. That's the only difference.
Okay. Next question, please.
We've heard on this panel and many others about this lack of clarity with digital assets, commodity security, regulation, this, that, the other. Yet this morning we heard from Chair Gensler that no, regulations is pretty clear. How we test is pretty good framework. So we're at a stalemate, right? So I think Neal mentioned and others have mentioned that ultimately Congress has to get involved. So what does that mean? Where do we go from here? What do you recommend? Do we contact our senators, Congress people, say, hey, this is important? What do we do? What do you recommend?
Neal.
So it's a great question for the senators that are going to be look, things get done when there's urgency in Washington. It's no secret, right? And so making this a more real, tangible issue for the senators and the House, I think is going to help. I think, there's a lot of, so you talk about disruption. The other flip side of disruption is inclusion. There's entire sections of the US population that are excluded from the current financial markets, and crypto and DeFi have an opportunity to fix that. Yeah. And so topics like that start to ring true for senators and House. And so, if you make it more urgent, it makes it more necessary. I look, he's the chairman of the SEC. He can say that it's very clear. There's a reason that we're all up here telling you that it's not. And we do this for a living with partners who work on SEC issues. I mean, I challenge anyone to read the 37-factor test and tell me you know what you're doing. It's impossible. It's really challenging. And so we need a framework, and this is a technology that didn't exist when all the tests and all the frameworks were put in place. And this is why we have Congress, right? To take the will of the people and put it into a framework. And so I think we do need Congress to step in.
I'll just add, Commissioner Peirce compared that framework to a Jackson Pollock painting, which I think tells you all you need to know about like how clear it is to apply.
Thank you. Thank you. Please.
Thank you. Jim Angel here from Georgetown. I'd like to know what you think about the following observation. What's different about cryptos is they're really not so much a new asset class, but a new rail, in that we've been tokenizing things in finance for 400 years. A paper stock certificate is a token of ownership. What's different about crypto is that we basically can transfer it digitally around the clock, around the world. So it's really a new type of wrapper. But what really matters for regulation really should be, what those tokens represent. Do they represent ownership interests in businesses? Well, then they'd be securities. They represent something else, well, then they represent something else. So what do you think of that observation?
I'll ask for the observations. Certainly, at Wilshire, we've been sort of, discussing this as an issue. Do we think digital assets is a standalone asset class? Our view is no. I think you have to look at each of these sort of tokens separately. We also think that the underlying technology is different from tokenization. The underlying technology, blockchain, enables you to do things in a different way, in often a more efficient way, but you can have some of the efficiencies without the use of that blockchain. Right? So I think you can talk about the technology separately. Tokenization offers an opportunity to tokenize and fractionalize different assets, particularly illiquid assets, even funds, a whole range of assets, and to be able to provide them in a way which would be more efficient and less friction for investors around the world. So that would be our view, but please, other views.
I think what you just said, I completely agree with. I think it's token to token, coin to coin, crypto to crypto as to what it represents. I think, and one interesting point I'll just mention about the legislation that I think hasn't quite played out yet in the press is the CFTC's jurisdiction, particularly under the Bozeman Stabenow bill, focuses on stable coins and talks about stable coins, but one of the exclusions is for a crypto that's redeemable for a physical asset, because there's always been a distinction between CFTC jurisdiction over the futures and derivatives markets, but not the underlying spot market. So the CFTC oversees WTI futures, but not transportation of crude oil. And so what do you do when you have a token that represents an ownership interest in crude oil? And I think the answer is it's not now subject to CFTC jurisdiction because you've turned it into something. So to your point, crypto to crypto, coin to coin, token to token as you analyze it.
Yeah. I could not agree more. And I'm thinking about the ETF as a wrapper as well. And I apologize because I'm a hammer. Everything is a nail to me. Everything comes down to ETFs. But if you have equity ETFs or fixed income ETFs, so they are regulated by the SEC. If you have ETFs investing in commodity futures, so they are regulated by the CFTC. So don't stop at the wrapper, look at the underlying, this is going to tell you how it should be regulated.
Agree with all good thoughts already expressed.
Okay. Now I'm going to end by giving each of you a magic wand. Okay. And with this magic wand, you can make one wish. And your wish for one change in the regulation space here, what would that be? Hannah?
Oh, I wish the SEC would clear the Bitcoin ETFs.
Okay. Susan?
I wish Congress would pass a law that draws a clear line between what's a security and what's a commodity in the digital asset space.
Neal, your wish.
I want a pony.
Please thank the panel. Thank you very much. Well done.